In the building materials industry, there are two types of growth: incremental growth, driven by massive infrastructure expansion, and replacement growth, driven by mandatory retrofitting. TGLS belongs to the latter. 1. Core competitive advantages: regulatory tailwinds and survival logic. Regulatory alpha, mandatory demand. Building codes in Florida and coastal U.S. regions are only moving in one direction: stricter. To reduce hurricane payout risks, insurance companies are effectively forcing property owners to install impact-resistant glass. As long as TGLS can outlast current high interest rates with its low debt profile, this inelastic demand acts like a reservoir that will burst open once rates soften. Low-cost survival logic. In manufacturing, survival is a contest of who can withstand losses the longest. Profitability. TGLS maintains gross margins, approximately 42%, that are roughly 15 to 20 percentage points higher than its domestic U.S. competitors. Solvency. Extremely low leverage. Net leverage 0.24 times ensures that bankruptcy is virtually off the table. Last man standing. Dynamics. This means when the industry hits a winter and competitors exit the market due to losses, TGLS remains profitable. This positioning allows it to gobble up market share at minimal cost when the next cycle begins. 2. Valuation analysis. A bond with a call option 1 might ask, if growth slows down or turns negative, is the current valuation too expensive? Conclusion. Based on free cash flow, FCF, yield, TGLS is currently priced in cigar butt territory. FCF yield. At a current market cap of $2 billion, projected 2026 FCF is approximately $150 million to $180 million. This implies that even with zero growth, the company generates a cash yield of 8%, significantly higher than Treasury yields or the S&P 500 average. EV/EBITDA, margin of safety. Its EV/EBITDA currently sits around 6 times to 7 times. For a vertical leader with 25% plus ROE and a healthy balance sheet, TGLS is effectively a bond with a call option, the floor, bond attribute. As long as it maintains current cash flow levels, even if growth stagnates, the company can forcefully drive EPS growth through share buybacks. As long as it survives, buybacks make each remaining share more valuable. The upside, option attribute. If the U.S. enters a rate cut cycle in 2 to 3 years and the real estate market recovers, the slow growth could suddenly accelerate. Coupled with a valuation multiple re-rating, shifting from 11 times PE back toward 16 times PE following its HQ relocation, investors could see a Davis double, growth in both earnings and multiples. Valuation floor. Even under a zero-growth model, an FCF yield above 8% provides a powerful defensive cushion. 3. Expansion plans, the option value. TGLS management isn't lying flat despite high interest rates. Their expansion logic is clear, pivoting from a single-point support, Florida/commercial, to full-scale penetration, national/residential. 1. Capacity expansion. Planting seeds for post-2027 growth management increased CAPEX in 2025 to focus on the automation of their Colombian production lines. Logic. Expansion isn't about blindly building factories, it's about using automation, AI plus robotics, to further drive down unit costs that are already world-leading. Goal. A planned 20 to 30% capacity increase over the next 24 months. This ensures that when the industry recovers, TGLS won't face long lead times. It can immediately fill the market with high-margin supply. 2. Channel expansion, replicating the Florida miracle. TGLS is executing a multi-state expansion strategy to reduce its heavy reliance on Florida, which currently contributes approximately 70% of revenue. Entry points, targeting Texas, South Carolina, and the New York/New Jersey region. These areas either have similar hurricane protection needs or strong demand for energy-efficient low-E glass due to low-carbon building regulations. Asset-light path. Instead of building local plants, management prefers penetrating markets via showrooms and distribution centers while keeping production in low-cost Colombia. 3. Product expansion, attacking the single-family home market, vinyl windows. This represents TGLS's largest growth lever over the next 3 to 5 years. Current status. Residential business already accounts for over 40% of revenue. Management intends to build this into a dual engine, equal to the commercial segment, effectively smoothing out the cyclical volatility of commercial real estate.